This is Al Brooks, and I am recording a blog on Friday, November 2nd, 2012, using principles that come from my Brooks trading course from my brookstradingcourse.com website. First, this is the Emini contract, the weekly chart, and I've pointed out several times recently that we have a bull trend line below, and we have a trend channel line above, and another bull trend line here, creating a wedge top. And we're very close to the first trend line, and we have a ways to go to get to the second trend line. Whenever the market tries to have a bull breakout of a bull channel, a wedge top is a bull channel. A channel is just price action contained between two lines. It does not matter that the lines are convergent as they are here. Whenever you have an attempt to break out of the top of a bull channel that fails and reverses back down, the market usually has to poke below the bottom of the channel. And there are often more than one bottoms. We have the initial one here, and then we have a bigger one down here. At a minimum, I think the market will poke below the bottom of the wedge on the weekly chart, and I think probably 50-50 chance will come down and poke below the pink line, the larger channel. And that would correspond with a test of this low. When wedges correct, and when anything corrects, the market always tends to get drawn down to support, and support is a magnet, and a prior higher low is a magnet. Bulls want the market to stay above prior higher lows because that's the definition of a bull trend. You have higher lows and higher highs, and once the market stops making higher highs and lows and starts making lower highs and lower lows, the market then is in a bear trend. So this prior higher low and this prior higher low are important. If the market falls below them and starts to make a series of lower lows and lower highs, then the market becomes a bear trend on the weekly chart. Here's the daily chart, and again you can see those two lines from the wedge, and we're very close to the first line, the wedge bottom. We should get through there next week, and you can see on the daily chart we have a high, a lower high, a lower high, and then another lower high, a low, a lower low, and a lower low. So the market's in the early stages of a bear trend. Remember, every bull flag is a bear trend. We don't know if this will just go a little bit further and then break to the upside and the bull trend will resume. That's what happened over here. We had a bear trend that was simply a bull flag within a larger bull trend. Same with over here. We had a bear trend that was ultimately just a bull flag. We don't know if what we have going on here on the daily chart is simply another version of that, or if it's the start of a significant bear move. I think at a minimum we'll get to this trend line below the bottom of the wedge, and I think there's a pretty good chance we'll get down here. Corrections tend to get larger each subsequent correction, and this correction here was about 100-150 points. So assuming that this is a correction and not just a bull flag, I would assume that it would be at least 100-150 points, probably getting all the way down here on the daily chart in the 1250 area. On the 5-minute chart, here are several days that this week that illustrate some points that I think are worth mentioning. Every now and then traders ask me what is an expanding triangle, and I talk about that in module 21, triangles, and it's simply a triangle that is expanding. It's getting wider instead of narrower, and so you have a high, a higher high, and a higher high, and you have a low and a lower low, and at a minimum it has 5 points to it. Sometimes it expands and has 7 or 9. Over the past couple of weeks we've had a lot of expanding triangles on all time frames, and sometimes the market just gets in that kind of a mood and it has a whole bunch of expanding triangles. Every expanding triangle top is then usually converted into an expanding triangle bull flag. So I could have carried this line across here, and then we would have had 3 pushes down, 3 pushes up. As long as you have at least 2 up and 3 down, you then have an expanding triangle bull flag, since it's in a bull trend. And we had a second entry over here. Let me just talk a little bit more about this expanding triangle top. Okay, every expanding triangle top is a major trend reversal. I talk about major trend reversals in module 17, and I talk about how to trade them in modules 35, 36, and 37. And let me go back to what I was saying. Every expanding triangle top is a major trend reversal. You always end up with a trend line break and then a higher high. When the market starts to turn down from the triangle, it's turning down from a higher high major trend reversal as well. You can see the market tried to turn down over here below the second bar of the day, but a doji bar, a weak signal bar. Here we had a bear bar closing on its low tick, a more reliable signal bar for the expanding triangle. We had a bear trend coming down here, and then a trend line break, and then a lower low that reversed up. Here, 4 bear bars, I would not buy that. Here, a second entry long for a lower low major trend reversal. I think that is a reasonable buy. We have a bull channel, a break below the bull channel, and then a new high. So a potential higher high major trend reversal. I think this bull spike, these 2 bars up, are strong enough so it's more likely that the market would have formed a higher low and had another leg up than it was that it would become a major trend reversal top. So I think it's perfectly reasonable not to take this short and assume the market was still always in long. This day we gapped up a trend from the open bull. We broke a trend line. The market went sideways to down for about 5 or 10 bars. Did not quite reach the moving average. And then we had a higher high and a 2-bar reversal. So again, a major trend reversal, a higher high major trend reversal. Given what took place earlier in the day, I think the odds are that this major trend reversal will not lead to a reversal and instead will lead to a trading range, which it did over here, and it became a wedge bull flag for a second leg up. When you're trading situations like this, where you know the market's always in long, there's no follow through on the selling, so it's staying always in long, I think you have to be looking to buy. And I think what took place over here and here are important. You know, you could buy above that bar and put a stop below. You would have been stopped out here. You can buy above this bar and put a stop below, and you would have been stopped out here. And you could have bought for a third time here. Usually, if I think the market's always in long and I take a trade, I did not take this one. I did take this one. At least I think I did not take this. I might have taken this. I usually use a wider stop, like a swing stop. You can use a fixed number of points, like 2 points, probably not enough in the E-mini, or 3 or 4 points. That's usually enough if the market is staying in bull mode. Just look at here. This is about a 4 or a 5 point pullback. What are the chances that the market would get back up here, let's say 5 points, before falling 5 points, right? On a bull trend day, the chances are good. In other words, probably 60% or better. So that tells you that if you bought anywhere down in here and risked 5 points down to here, right, for a test of the high, it's a reasonable trader's equation. You got probability 60%, and you have reward equal to risk. So if you buy here looking for a move up there and risking that same number of ticks down here, I think you have a reasonable trade. If the market started to fail, you would not have allowed the market to come all the way down to your stop, right? So your initial stop is a catastrophic stop. You know, you have no intention of ever letting the market reach it. But I think it's a reasonable way to approach the trade. So when the market's channeling down, as it is here, you're not sure exactly where the low is. And, you know, you can see the market took 3 attempts. You could repeatedly allow yourself to get stopped out, or you could just buy any of the 3 attempts and use a wide stop and trade smaller. I think that is a better approach when you think the market is always in long, because a lot of times this is what happens. You buy, stopped out, buy, stopped out, buy, and all you do is get back to break even and you don't end up with a profit. On the other hand, if you use a catastrophic stop, it will not get hit very often. Usually, if the market's failing, you'll get out before it gets hit. And I think that's a better way to take the trade. You look for the buy setups, that's fine, but I would use a wider stop, a swing stop, whatever you think an appropriate swing stop is. Maybe below the low of this bull bar, so that would be over here. Or you could use a measured move down based upon this height, right? This high to that low, measured move down would be about here. You could also use all the way down here or below the low of the day, but I think that's too much. When the markets went up on this big bull bar, possible trend from the open bull, you had this bull bar, another bull bar. On one of these 2 or 3 bars, the market's always in long. When the market's always in long, especially a trend from the open bull, you want to buy for any reason. And if you don't come up with a particular reason, you just buy at the market. You buy at the close of a bar. You buy at the close of this bar. Stop below the bottom of the spike down here. So you say, well, I don't want to risk 6 or 7 points. Well, if you're buying up here, that is the ideal stop. So you trade small. You trade 25% of your normal position size. If you don't want to trade too small, let's say you bought this close, you could put a stop right below the low of this bar. And there you're risking 3 or 4 points. Maybe you trade half size. And that's still okay. It's better to trade half size and catch 2, 3, or 4 points than it is to keep waiting for a pullback and not getting it until up here and then missing a lot of the bull trend. So once the market becomes clearly always in long, either on this bar or this bar, I think it's good to buy for any reason, even if you have to buy small. You can always add on with a pullback, but I think it's important to get long when you think the market's always in long. By the way, this expanding triangle, you could carry it all the way out here or out here, and you can see it's a larger expanding triangle. So maybe on a 15-minute chart, it becomes a larger expanding triangle. And that is the end of my blog for today, Friday, November 2nd, 2012. Thank you for listening.